is that the incremental orders that we were to pick up in Q3 declined by 12% as compared to the Q3 of the previous year. But it's good to bear in mind that when we look at 9 months performance, as we have been speaking to you in the past, the order inflow has been fast forwarded in the current year, and that was expected and planned. So we picked up significantly large orders in Q1 and Q2. So we had the cushion of larger orders into our kitty during the 6 months period that was able to absorb the decline of 12% in Q3, and yet at the end of 9 months, we still are ahead by 16% on a year-on-year comparison basis. And you will recall that we had put out a guidance of 10 to 12% growth in order inflow for the period FY19, and given the fact that we are plus 16% as of December, at least puts us on good course to stay within the guidance that we had given out earlier this year. The order book for the 9 month stays at 5% growth, and the revenue for the 9 month, unlike the quarter, which grew by 24%, is up 22%. EBITDA is up 31%, and profit after tax is up strongly by 31%. Speaking about the order inflow for the Q3 ended 31st December 2018, the company won orders worth 422 billion rupees, which is in comparison to the 482 billion rupees of the previous year's third quarter is down 12%. The feature of this quarter has been the 22% decline in the domestic orders. Last year in Q3, there was strong surge of domestic orders. And actually last year it was only in Q3 and Q4 that the order inflow warmed up and picked up pace. And so consequently we had a robust Q3 in the previous year. But in comparison, the current quarter, even though 307 billion rupees is still a very significant order win for the quarter, looks 22% lower. On the contrary, the international orders improved in this period by close to 30%, from 88 billion rupees to 115 billion rupees. And despite the volatile international environment caused by the socio-economic turbulence, the economic sanctions, and the safeguards, the duty safeguards, and obviously the geopolitical tensions, we've been able to sustain in the markets that we are operating our interest and our clients' interest, and hence we were able to grow our order inflow by about 30% in Q3. For the 9 month period, we've crossed $1 trillion rupees. The total orders that the company has won for the 9 month period is 1.2 trillion, which is up 16% as compared to the 1.03 trillion of the previous year. Unlike the Q3 situation, the domestic order for a 9 month period records a growth of 20%, from 762 billion rupees to 912 billion rupees. This is largely on the account of the order wins earlier this year. The international orders have also grown in this period, but more moderately than compared to the Q3 situation, where it's grown by 10%, from 272 billion rupees to 291 billion rupees. The order book consequently, as of 31st December 2018, stands at 2.8 trillion rupees, a growth of 5% over the 2.7 trillion rupees, and nearly 80% of the order book is in the domestic market, and with the balance in the international markets. The orders that we have picked up during the course of the year largely comes from infrastructure. The investment momentum continues to be in that space. Consequently, our bids have been largely focused around the infrastructure sector, and so has been the order wins. Hydrocarbon sector has joined the party in this period. We've had fairly significant wins both in domestic markets and international markets. So nearly 13% of the orders that we have won in the 9 month period is from hydrocarbon sector. The services sector, where for statistical purposes we include the income earned by the services as orders placed on us to deliver those services, has grown handsomely by 20%. And that's a significant move up as the services business that we run in our portfolio begins to get stronger. The order book, which is 2.8 trillion rupees, has nearly 75%, 77% to be precise, in the infrastructure segment, followed by about 12% in the hydrocarbon sector. So much of the project work that we do, which carries on for a few years to execute and complete the orders into sales cycle, is largely resting between the infrastructure segment and the hydrocarbon segment. As you know, power segment has not been beneficiary of a lot of order flows, so they continue to remain modest. The revenues for the company, as a group, for the quarter 3 has been at 357 billion rupees, up 24%, and for the 9-month period is 961 billion rupees, up 22%, quite close to the yearly number of 1.1 trillion for the entire year of FY18, the previous year. The share of international revenue has been around 33% for the 9-month period, and pretty much similar for the 3-month quarter ended December as well. The manufacturing, construction and operating expenses at 235 billion rupees for the quarter 3 is up 28%, and for the 9-month period is up 21% at 608 billion rupees. Since financial services business uses money as raw material, the interest cost that they incur is treated as part of the input costs early on in the schedule, and hence the cost incurred by the financial services business for the quarter is at 20 billion rupees, up 29%, and at 54 billion rupees is up 22%. It's worthwhile to bear in mind that the revenue growth far exceeds these percentages of growth, so consequently the profitability of the financial services business has improved, and you could see that later in the presentation. The staff cost at 46 billion rupees for quarter 3 and 135 billion rupees for quarter 9-month is up 20% for quarter 3 and 21% for the 9-month period. The increase is largely on account of the augmentation that we have done in our services business. As the services business begins to grow larger within the portfolio, it's a very people-centric business, so it is important for us to staff these businesses, the IT, technology services, as well as the financial services business, with the right kind of talent. The sales and administration expenses of the company, of the group rather, for the quarter 3 at 17 billion rupees is down 12%, largely because we are carrying far less credit cost in this period. The ECL provisioning across the businesses that we run and the credit cost of the financial services have been far lower and under significant control during quarter 3 as compared to the quarter 3 of the previous year. However, on the 9-month basis, the sales and administration expenses is up 11% at 57 billion rupees. Consequently, the total operating cost of the group at 317 billion rupees for the 3-month period ended December and 854 billion rupees for the 9-month period ended 31st December is up 24% and 20% respectively. EBITDA for the quarter 3 is at 40 billion rupees, up 27%, and for the 9-month period is 107 billion rupees, up 31%. The margins consequently have increased by 30 basis points for quarter 3 at 11.2%, and the EBITDA margin is up by 70 basis points for a 9-month at 11.1%. The interest cost incurred by the group, excluding financial services, which we saw earlier, is at 5 billion rupees for quarter 3 and 13 billion rupees for the 9-month period, up by 48% and 16% respectively. The interest cost is higher in quarter 3 in line with the additional borrowing that the group had made during the quarter in question. The depreciation amortization at 4 billion rupees for quarter 3 and 16 billion rupees for the 9-month period is in line with the depreciation amortization policies of the company. The other income is up at 6 billion rupees for quarter 3 and 13 billion rupees for the 9-month period. It's up at 183% and 30% respectively. Much of the borrowing that the company raised to keep the liquidity buffer within the system, given the liquidity constraints that the markets were going through in October, November, December period, as you might recall, was actually not consumed in working capital but invested in safe treasury instruments. And that has been largely the reasons as to why other income has stepped up significantly in quarter 3. And this has to be seen in the context of the rise in finance cost as well. So it's, in a manner of speaking, treasury management to make sure the businesses have the requisite liquidity should liquidity get into some kind of difficulty for the system as a whole and not necessarily for the company. The exceptional items have nothing to be reported for quarter 3 and 3 billion rupees for the 9-month period, and hence the profit after tax for the group is at 20 billion rupees for the quarter 3 is up 37%, and at 55 billion rupees is up 31%. We now get into the segments and see how they have performed in terms of their revenues and profitability. And there are no changes to the segments that we had reported in the earlier quarter. Starting with the infrastructure segment, the segment has turned up a very strong performance. On the back of a 9% order inflow growth for the 9-month period, the segment converted very successfully the order book into revenues by progress on the execution of several jobs, and both in India and in the international markets. And we have a 24% raise in revenues of the segment for the 3-month period ended December at 182 billion rupees. And for the 9-month period ended December 18, the segment revenue grew by 19.2%. Out of the revenue, 47 billion rupees for quarter 3 and 128 billion rupees for the 9-month period is from the international business, roughly translating to about 25% of the total revenue. And the revenues from the international business has grown by about 5%, both in quarter 3 as well as in 9-month period, reflecting the execution pace in the international contracts. The EBITDA margin for the quarter 3 is at 5.4% for the infrastructure segment, down by 250 basis points on a year-on-year comparison for third quarter, and for the 9-month period at 6.3% is down by 130 basis points. The EBITDA margins largely reflects A, the state of the jobs that we are executing, B, the mix of cost jobs to margin generating jobs, and C is the cost provisions that we have carried in the infrastructure segment, particularly the transportation infrastructure segment, the claims for which are pending with the clients for certification and approval. As and when these claims come in accordance with our accounting practices, they will be credited to the profit and loss account, whereas the accounting conventions that we follow has the cost accounted for it as and when incurred. Power segment has not had a good run so far this year, and that continues into the quarter 3. We have 9 billion rupees of orders, which is down by 28% as compared to quarter 3 of the previous year. And for the 9-month period at 30 billion rupees is down by 35%. The lack of revenue comes from the fact that the order book that the segment has been declining, and it is not getting replenished adequately by new orders. A, the number of opportunities that are available to the power segment is limited, and B, the capacity is so much in excess that there is intense competition for whatever opportunities that come up. And since, as a matter of bidding discipline, we would like to bid for jobs which we can execute within time and with profits, it is quite understandable as to why our order wins on the power segment has not been as significant as it used to be a few years ago. The international jobs that we have been winning is in Bangladesh largely, and we've been over the last few years winning jobs in a series, and the execution of these jobs have been progressing well and profitably. So consequently, you will find that the international revenue from the segment has grown by 41% for quarter 3 and declined by 3% for the 9-month period. The margins, however, are up at 0.5% for quarter 3 and up by 130 basis points for 9-month period. It is to be borne in mind that these represent the EPC margins, because the profits out of the manufacturing JVs that we run are aggregated and consolidated at the PAT level and not at the EBITDA level, because of the joint control that we have for these units with Mitsubishi Heavy, our joint venture partner. Heavy engineering segment has done very well. After a lull in the market, there are a lot of opportunities in the refinery and oil and gas sectors. Last year, we saw some significant orders that heavy engineering won in the nuclear sector. So far in the current year, the nuclear sector has remained a little quiet, but more than substituted by the activity that is happening both in India and in international markets in the areas of refineries, fertilizers, and oil and gas. The revenue growth has been 82% for quarter 3 at 6 billion rupees and at 56% for 9-month period with 14 billion rupees. The international revenues, or rather revenues from orders that we execute for international clients, are almost 50% on a quarterly basis at 3.8 billion rupees, up 126%, and 50% at the international at the 9-month period at 7.7 billion rupees, up 65%. The EBITDA margins are very healthy at 20.5% for the quarter 3 and 25.4% for the 9-month period. Even though the volumes are not very significant in this business, it is very important to understand that this company has over period developed technology differentiation, which makes it among the best in the world in terms of delivering equipments meant for the sectors it caters to. And it has an enormous track record of over 30 years, and most of the clientele it serves are repeat customers, and that endorses the efficiency in both production as well as delivery. So consequently, the margins of these business are very heartwarming. The defense engineering segment, which is a new segment which during the course of the year we carved out of the heavy engineering, erstwhile heavy engineering segment, has done well. The revenues at 10 billion rupees for Q3 has grown by 36%, and for the 9-month period at 26 billion rupees has grown by 18.2%. The revenues have benefited from the execution progress that we had on the gun program, and recently, a few days ago, we had the honor of the Prime Minister inaugurating our gun factory in Azira, and the first in the private sector of the capability that we have packed into that factory. And hopefully the order providers would take notice and use these facilities for the country's security and defense purposes. The EBITDA margins at 9% for quarter 3 and 15.2% for the 9-month period reflect the state of progress of the orders that are under execution. Electrical and automation segment has had a good year so far, and the Q3 is no exception to that. The industry is growing, and the company has grown in the areas that it is operating at a rate faster than the industry growth. So consequently, has been able to access additional market share. The segmental revenue at 14.7 billion rupees for quarter 3 is up nearly 20%, and at 41.6 billion rupees for the 9-month period is up 16%. Some portions of this business are meant for international markets, and as you can see, for quarter 3 it is 3.6 billion, up 5.7%, and 10 billion rupees for the 9-month period, which is just minus 1% as compared to the previous year. The margins are stable for the quarter 3 at 17.4%. However, for the 9-month period, the margins have improved by 180 basis points from 14.4% to 16.3%. The growth drivers for this business has been across the verticals, be it industrials, buildings, or agriculture, and rural electrification. And the operational efficiency, product mix, as well as the increasing market share has enabled improved realization, which has resulted in improvement in the margins. Hydrocarbon sector has had a cracker of a year and a quarter. Quarter 3 has been revenues have been up by 22% at 37.6 billion rupees, and at 108 billion rupees is up 32% for the 9-month period. The order flow in the segment has been extremely encouraging, and we've been able to meet our targets insofar as the orders are concerned, both between domestic markets and international markets. The EBITDA margin of this sector at 8.2% for the quarter ending December 18 and 8.4% for the 9-month period is in line with the plans that are afoot insofar as these jobs are concerned. Coming to services, we report both the IT and technology services, two listed independent companies, as one single segment. And combined, they have aggregate revenues of 37 billion rupees for quarter 3, up 28.8%, and at 106 billion rupees for the 9-month period is up 30%. Strong revenue growth led by verticals in information technology such as banking, financial services, CPG, retail, pharma, high-tech, media, entertainment, and in terms of technology services by transportation, telecom, high-tech, and process industries. The margins have improved as well. We have 22.2% for quarter 3 and 23.7% for 9-month period. And both the growth rate on revenue and margins are fairly industry-leading indicators, and you would have heard more about these when these companies came out with their detailed results and post-result analysis sometime last week. The developmental project segment that we have is a combination of the power development business that we run, the Hyderabad Metro project, which is under execution, fast approaching completion, and the Kattupalli Port project, which until early this year was held by us until this divestment. The revenue of the segment at 11.9 billion rupees for Q3 is largely from the power development and the Hyderabad Metro, and Kattupalli was not contributing to the Q3 revenues. And the 9-month revenue at 39.9 billion rupees is up nearly 30%. The margins at 4.2% for Q3 and 14.1% for the 9-month period are reflective of the performance of the power segment and the Hyderabad Metro segment. As we progress Hyderabad Metro to completion, we will possibly have the full impact of capitalization into the segmental performance and results. The financial services segment, like the IT and technology services, have done very well. The revenue at 32.6 billion has grown by 23% for the Q3, and at 94 billion rupees has grown by 29% for the 9-month period. And the profit after tax at 3.9 billion rupees for the Q3 is up 89%, and 11.3 is up 89.4%. These profits are representative of L&T's share of their overall company's profit. The segment had fairly strong headwinds during this quarter because of the developments in the financial services segment that you're all well aware, but the company did very well to steer through this volatile phase and stay liquid and continue to put their head down and disburse against quality credit. The focus of the business continues to be retail oriented with NIM expansion and superior ROE as thrust areas. Coming on to the other segment, the segment consists of our industrial and products machinery, which is construction, mining, machinery business, and valves, as well as realty business. The revenue of this segment at 16 billion rupees, up 77.4% for Q3, and 43 billion rupees, up 65% for the 9-month period, largely represent the momentum that the realty business contributed. We had an asset which we built, a commercial asset which we monetized in this quarter, and that contributes largely to the revenue and the profit growth. The EBITDA margin consequently on the back of that monetization for Q3 is up at 47.2%, and for the 9-month period is at 32.9%. So with that, we conclude the formal presentation and throw open the floor for discussions. Thank you very much.
See, perfect time.
Absolutely. We are in sync.
Hi guys, good evening.
We spoke about the fact that there was the order inflow was a little muted in Q3 because some have been deferred to next quarter. What is the outlook you have for Q4? Given the fact that in FY18, the last 2 quarters were the strong quarters in terms of order inflow. So even though on a 9-month basis you are 16% up on order inflows, do you see Q4 also to be muted, and going forward the first quarter to be muted as well as the elections take place?
A couple of points here. One is being a project business company, this quarterly measure is highly misleading. There are quarters where we run dry and there are quarters where it just pours. I think we need to take heart and feel happy that at the 9-month period we are up 16%, so ahead of the asking rate. And Q4 is yet to play out. As things stand, the pipeline looks encouraging, and we are hopeful that we will stay on course insofar as our guidance of 10 to 12% is concerned. What happens in Q1 is actually a bit speculative now because there is an election quarter, and I think it will be prudent to plan that the last bit of Q4 and much of Q1 will be a dull period as far as fresh ordering is concerned.
About margining in the infra business as well in Q3, 5.9% versus 7.9%. Is it primarily because of execution, non-completion of the execution, and that's why deferring of the incomes coming in, or is it there is a real pressure on raw margining in this segment?
Actually, the margin, there are a couple of levers which actually trigger the margin. One is as you take the job has to progress up to 25% for us to start recognizing margins. So up to 25%, you will have cost being accounted and sales getting contributed. So the effect of that on margins will be dilution. So given the fact that in the first 6 months we have won several orders and the order book is pretty healthy and we are brisk in conversion of that order book, the job mix between cost jobs as well as jobs which throw up margin after the threshold is such that you're having most of cost jobs now at this period. Okay. So I don't think you need to draw much more out of this trend in terms of cost pressures. We also made a point that normally as we complete the jobs, because there are also a mix of jobs that are nearing completion, we incur the cost, complete the job, and as is the case in our business, there will be a lot of client negotiation settlement on the claims that will happen. And that will normally happen at the back end of the job. So the cost gets accounted as and when they are incurred, and the claim as and when they are settled would flow into the P&L at an appropriate time whenever they are settled. So this timing mismatch does at times vitiate the flow of margins. But so far as we are concerned, I think we do think that some of these settlements will slip into the next year. So the cost will stay embedded in the current year financials. But having said that, we have given a guidance overall of a 25 basis point improvement in the margins as compared to the previous year. We do think we will stay within that guidepost for the year, notwithstanding the Q3 blip that you're seeing.
So what would be the amount of claims that are may slip into the next year? And can you give us a proportion of whether it's public sector or more private in nature?
No, most of the jobs are public sector today, so it will be public sector.
Public sector. What would any amount?
The amount is not prudent to talk about the amount because the claim process is such that we should not be seen as vitiating or building a public opinion on the claim amounts. It is completely bilateral and between the client and the company. But suffice to say that this margin dip that you saw by 250 basis point is not something you need to structurally worry about as though infrastructure margins have collapsed.
No, my point was, is the market getting hyper competitive in terms of all orders, infra orders coming in, price, especially with respect to pricing, which is there?
The competition remains normal. We don't see any major influence due to that. As Shankar said, this is a combination of factors. One of the factors is also certain claims to be got. And this is a continuous process in business, especially when you're dealing with public sector and government. This particular quarter, there's a blip. But overall, as he said, for the year, we expect to maintain our guidance and move forward with that. Okay.
So Priyanka Iyer from BTVI on your left. So just to understand, firstly, what is the working capital trend currently as a percentage of sales? Were you able to reduce it as compared to the previous quarter?
It's like a stubborn teenager. It stays at 19. I'm trying to get it down, but it's around 19 and a half. So.
Also, sir, after SEBI has rejected the buyback proposal, what will be the next step, especially for your ROE targets for FY21?
SEBI has written to us saying they don't approve the buyback as they see it. We have studied the letter. We're evaluating various options. The reason for denying the buyback has been the inclusion of our financial subsidiary, which is an NBFC, into the consolidated outlook and debt of the company. It's a bit harsh order. We are studying it. We will take a look as we go forward.
So just a continuation to that question, what would have been the debt-to-equity ratio if this buyback had gone through? And now, is there any plan for investors to downscale that buyback or give a dividend if that's all?
See, the standalone debt-to-equity ratio is 0.17. And if the buyback had gone through it on a standalone basis, for which we had proposed, it would have become 0.2 and odd. Now, since they've included the financial subsidiary, it's difficult to calculate per se because financial company borrows money and lends money. And in an NBFC case, since it cannot take bank deposits, the only way it goes forward its business is by borrowing money and lending money. In that case, it exceeds 2.1 or something like that, and that's why they are not allowed us to go forward with the buyback. I think this is a deep question to be looked into and analyzed, but not only by us, but the rest of the business community, including SEBI. And I think the rationality will prevail on how to do this. Now, this is something which we're going to talk to SEBI and maybe even take it up with them in a nice manner. But having said that, to react on it by immediately saying we will declare an interim dividend, etc., is not prudent. It's not the end of the world as we see it. So we'll discuss and see how to overcome the situation, because in our view, as an organization, we just have a standalone debt of 10,500 crores. And that is for the scale of the operation that we have, and it's very, very reasonable from our point of view. One of you, give others a chance. I'll come back to you.
So, go ahead.
No, first him, yeah.
Sir, in this rejection of buyback, do you think there is some sort of interpretation issue was also happened?
As I told in my press calls immediately after the buyback rejection letter came to us, there seems to have been an internal rule of SEBI which looks at the consolidated debt of group companies when it comes to this buyback. And they seem to have applied that in our case. This was not in the public domain, and we were not aware of it. And that's how this rejection has taken place. So as I said, we have studied the letter, we have discussed it internally, and we will see the most prudent way forward on this matter.
Mr. Subramanian, you spoke about the fact that the SEBI order, which rejects your buyback, is harsh, and you said you're also considering a few options.
I felt it was a bit harsh.
Usually when companies feel that orders or directions from the regulator are harsh, in some cases they take legal recourse by going to the Securities Appellate Tribunal, where you can knock the doors if you don't agree with SEBI. So if both the parties don't arrive at a middle ground, is legal recourse something that could be possibly considered by L&T?
There are many ways to go about a matter which you don't agree with your partner. SEBI is a market regulator. We'll find ways to go about it.
All right. Mr. Raman, during his presentation, said that there's been a solid all-round performance by the company, but he also spoke about the fact that the sore point is that there was a dip in the incremental orders. Mr. Raman, if you could elaborate on what led to that.
I'll clarify that. Okay. 42,000 crores is $6 billion worth of order in a quarter. Please appreciate Shankaraman on what he said.
No, I'm just quoting what he said from the
IT companies,
presentation.
when they declare so many orders, much of it is rebadging and renewal orders. This is fresh, cookie fresh orders. $6 billion. Give us a smile, give us a good headline.
Oh, definitely. I mean, since we're on the topic of IT... No, so since we're on the topic of IT...
Time to come back to engineering.
No. no. Sajid, hold on. So, I'm not done. Just one more question, then you can come.
Yeah.
So since we're on the topic of IT and since we're all smiling, I thought I'll ask you, what is the plan of L&T as a conglomerate, as a whole, in terms of inorganic activity in the IT space? You know, you do have presence in the IT space, do have 2 listed entities, but it's, everybody is aware that there have been plans to scale up and become a more serious player. So what is L&T's plan in terms of M&A activity in the IT segment? And if there are serious plans, how aggressively are you pursuing Mindtree?
My dear friend, this is a quarter to reflect on our performance for the previous quarter and to give you some optimism on the way forward to the next quarter and by the year. But anyway, having said that, and you having broached this question, to keep it in a small context, as you see L&T today as a group, if you see the valuation of the entire group, roughly about 2,45,000 odd crores, L&T plus LTI plus LTS plus L&T Financial Services. Our intent and goal long term, as was stated in the last Lakshya strategic plan, has been to grow our services faster than our existing core business, as we call it.
Right.
Prudent from the fact and the point of view that the services business seems to have a better margin than the core EPC projects business, because project business are risky, are tough. Of course, you do great things, but there's a risk comes with that. And unfortunately, the world does not give you a premium for the risk and gives a premium for the services business. Having said that, it's good to grow that business. LTI and LTS have done well. And as we look forward to it, that's an area that we want to look at and see how to take it forward. We have, as you know, time and again, through those companies, which are independently listed companies, they have been announcing certain niche acquisitions or certain, what you call crucial acquisitions from their operations or from their talent addition point of view. So we'll continue to look at the space and see how to take it forward. As far as the acquisition, the name that you mentioned,
right.
We look at all opportunities, but at the moment, it's all speculative till we arrive at any conclusions. At the moment, there is nothing in front of us, We continue to grow the business as we see it.
Right, thanks. Yeah.
Hi, good afternoon, Rachita here. In terms of the orders, we've already discussed it, and the absolute numbers are still very big, but we did see a slowdown in the domestic orders. But this was kind of supported by the international growth. What's the outlook on the international orders? Is it likely to continue to be strong? Because we have seen of a bit of a up and down in the international orders. So can you just give me your outlook on that?
Rachita, it's both domestic and international, in my opinion, have the same trend as I see it. There are good prospects in international, both Middle East, which is our major area of operations, certain extent in North and East of Africa, where we are fairly, I wouldn't say very largely present, but fairly present right now. So there are good prospects for which we have bid for in these parts of the world. And as we go forward, we do expect prospects to turn into real orders. We do hope that those will come through. We normally don't speculate on which orders will come through, but we're quite hopeful, and there are fairly serious orders there. India domestic will see some slowness in the last part of the month of March, maybe because of the elections. But at the same time, those are government orders. The public sector orders and the regular private sector orders will continue to flow through. We do see some activities moving on the private side. That you see some movements on the industrial side, you see some movement on the airport side, so on and so forth. So that will continue to move. The public sector also, some major expansions are being seen, and that will continue to grow. What will go slow is probably the government kind of orders. We have a fair amount of them right now from some of the major states where elections have recently been concluded. That may get concluded in the next month or so. So as we said, we are reasonably confident of not only going through with the order prospects as we said for the year, but maybe slightly go ahead of it by 25 basis points. So we are there.
Okay. And the other thing I wanted to understand, you were talking about orders from Bangladesh for the power unit. What is the capacity utilization now? And clearly we don't see much of a pipeline in the domestic market. So will there be an effort to increase orders from the overseas market? And what's the pipeline looking like in that very specific segment?
Let me clarify. The power sector has got two aspects of its business. One is a coal-fired thermal plants, for which our factories are built, both the boiler and turbine. And we normally concentrate on the supercritical ones, that is greater than 600 megawatts, less than 1,000 megawatts. The Bangladesh order is a gas-based power plant. We have done 3 already, and we have bid for the 4th one, where we are L1. And it's an Asian Development Bank funded project. We do hope that before year end that goes through. The prospects for gas plant are there not only in Bangladesh, we see some prospects in Middle East and other places. So we'll continue to pursue that. But in the gas-based power plants, we don't supply the turbine. It's through one of the big names, and we join with them as either an EPC or as one of the main BOP players and take it forward. Where we need orders is a coal-fired one to fill up the factories, both turbine and boiler. As much as we see, turbine is okay for another year, not only because of the existing domestic orders which we had got earlier, but some of the export orders that we have got from our partner. And the boiler, we have sufficient orders for another 2.5 years. So there's no panic as of it right now, but these are factories, they need orders. And even if we get an order, it takes some time to design and build it up. And therefore, there is a need to book an order within the next 6 to 8 months, 6 to 9 months, let me say that. And we need to pursue that with as much vigor as possible.
And just cross-checking, you said 25 basis point incremental on the order inflow.
The order inflow will be 10 to 12% growth, slightly more.
Okay, thank you.
On the issue of buyback, there's an issue of interpretation of whether it should be a standalone or a consolidated when you look at the debt equity ratio. Now, if you look at credit rating agencies and when they rate you, they look at consolidated as a whole group and not as a standalone. So if SEBI is taking that view that, okay, they should also be taking a consolidated view of the group, what is wrong in that interpretation?
Do you include an NBFC in that?
When credit rating agencies do it, they don't include NBFC?
Let me clarify this. First and foremost, returning cash to equity holders of a standalone company is whole world different than the credit rating agencies looking at debt servicing capability of the group. They're two different, they're not a direct connection at all. And secondly, there is no interpretation, no room for interpretation, because both the Companies Act as well as SEBI's regulations very clearly talk about the financials of the company post buyback. And company can never be read as group. Now, if you want to go beyond what is the prescription of the law and have a tighter threshold, that is up to the individual agencies. Okay? SEBI has not got into any interpretation. Neither have we got into any interpretation war with them. The question is, what is the appropriate safeguard that SEBI should use for safety of the minority shareholders? I mean, we have seen companies who actually take away their shareholders' money and disappear. Here is a company which is trying to give money back to the shareholders. One. Two, this is a first-in case in terms of a conglomerate trying to do a buyback. It is very simple when services company, and mostly it has been largely IT companies and sometimes pharma companies, monoline, no web of SPVs and stuff like that. It was an easy decision. So in a way, it's a case point. So I don't think we should reduce it to an interpretation warfare. I think it's a question of evolving space. And we are very sure that I think with cool head and mature minds, we should be able to find a mid-path.
Because the reason I'm asking is that despite the SEBI's direction, the company hasn't come out and said, okay, if buyback is not the way to, is not allowed as a way to return cash to the equity shareholders, what is the other way we have? Is it a special dividend or any other way? Why has the board considered those options as well? You had.
I think I answered it just now to your colleague from the other papers or the channels.
But you said you will be looking at options, and before that you will be looking at consultation with SEBI before you coming in.
My dear friend, the ink is hardly dry. This was received few days back. Okay.
You had a board meeting today, so
but
I'm sure
the ink has to dry even for it to go to the board, right? I mean, you need to absorb what is the issue, and it's a fairly significant issue. It's not something you can be flippant about, and there's no reason for any knee-jerk reaction. If not this, that. I mean, there's no. Look, what is the company trying to do? Trying to create value for shareholders. Now, in that scenario, it does not mean if I am shut out here, I will go here. I don't have to run around like somebody who's trapped in a room. We need to have a very matured response to this. And we should not lose sight of the plot of value creation. Now, is dividend going to create value? Is share buyback going to create value? Is investment going to create value? These are several options that the company will have in front of it. So be rest assured that this company will look at all options.
Is there a timeline within which you want to settle this question?
No, there is a timeline.
Buyback or you abandon the plan?
No, there is a timeline for appeal. Okay, that by default sets the timeline for a resolution. So if you don't want to go appeal, but you still want to engage and pursue for the larger interest of the industry and maybe future course of action, there's no timeline. The issue has to be understood, addressed.
I think clarify this, that it's an 80-year-old company. It went public 45 years back. Every year's dividend has been greater than the previous year's dividend. Last 7-8 years, we have given 3 bonus issues. So the idea of the management is always enhance shareholder value. Share price, which was about 180, is today 1,300 odd with 3-4 bonuses. So huge value creation that has taken place, nearly 200 times, I think. Now, having said that, the idea was to create value for the shareholders. We had the money in our hand. We said one of the ideas was to do a buyback and give money back to the shareholders. That idea has hit a temporary speed bump. We'll evaluate other options. It's not that it was not a IPO or something like that which has hit a bummer. It's a buyback that has hit a bummer, and we'll find other ways to do it, if not this way. Or maybe this way itself may come through, so let's wait and see how it proceeds.
And about your finance arm, it's growing at a fast pace.
Yeah.
Does it require capital going forward, or is it in this equity capital going forward because the kind of pace it is growing in? And if that happens, it brings you a solution as well, because you on a consolidation basis, if you just bring it down below 50, your debt to equity also comes down, right?
Yeah, I think in January of 18, the financial services business raised capital. raised about 3,000 crores. And I think it should carry that business through for another year at least easily. And then we will have to evaluate, but it is not anywhere in this year or in the next year. It will be in the following year, if at all.
So one question as far as the deal with
To
Schneider.
clarify your point, it's a business in which L&T is invested. We have a 65% shareholding and it's doing well. And as I said, we'd like to grow a services business. So it's part of that overall ecosystem there. And the idea was not to move it away. There's no way our idea. You said bring your equity down to 50. Let's not look for quick fire solutions. Let's look for a prudent, matured solution how to take businesses forward. It's a serious business for us. We are growing that business. It's doing well. We'll continue to see how to grow the business.
Sir, as far as the deal with Schneider Electric is concerned, of course, that CCI approval is pending in that particular situation.
Yeah.
What has been the talks, discussions with the Competition Commission of India? How soon do you expect that approval to come in and the deal to actually move forward and conclude?
It's a process. It's a work in progress. The matter is still pending. Let's see how to take it forward. We cannot comment because it's now within the CCI and discussions are continuing.
Yeah. The public consultation process has concluded.
Yeah, we did mention
yeah.
that it will take 12 to 18 months when this process started. And being a large business, we did anticipate it will take that long, and true to anticipation, it is taking that long. So I think with every passing day, we are nearer the completion.
At the same time, business has done well.
Sir, what to understand about this Shivaji Smarak status? Because we have heard that the first tranche requirement from L&T was of 140 crore and government of Maharashtra has only sanctioned 7 crore only. So that might left it on large. So if you can clarify this, what actually it is, because so much of...
I will after this press conference immediately ask you for your source of your information. The project has been, contract has been signed. Earlier it was with some Shivaji Statue Implementation Committee. The government has transferred the project to the PWD, Department Government of Maharashtra. So that process within the government is not necessarily a day's process. It's taken some time. The budget was allocated again to that committee. The budget has now to be retaken up by the cabinet and allotted back to the PWD. That process is going on. And hopefully matter should get settled in another 15-30 days and project should go on full swing. At the meantime, the design and preliminary works are started. We need to get the advance and the billing started, and that is what is being awaited for due to procedural matters.
Sir, when we have seen a steep rise in orders from hydrocarbons, where are these orders coming from, and are they sustainable going forward?
Do well, you're asking sustainable. If you don't get orders, you're saying what is wrong with you. So anyway, having said that, we're getting used to this. So hydrocarbon has done well. It was a little bad shape about a few years back. I think the leadership therein has, it is two major places where we get orders in hydrocarbon. It's India and Middle East. So India also has seen domestic capacity build up. We got orders from HPCL, IOCL, ONGC and such. In Middle East, our orders are predominantly been from Aramco and one order from ADNOC. So overall, all the major clients are pushing out projects with oil prices ruling still at that 70, 80. I think there is some, what was not happening last few years is happening right now. And as we go forward in our business, this question of future always comes in. Projects needs to keep expanding. Energy is a must and a requirement for all of us. And I suppose as long as energy is a requirement, something or the other will keep happening in this space. So we are positive there, yeah.
In terms of the growth guidance, are we maintaining that?
Yep.
Rachita, headlines. Of course, you only been asking. Now you take my permission all of a sudden. Most welcome, yeah.
On the defense front, we saw you starting a new facility. which was where the Prime
The
Minister...
K9 Vajra gun, yeah.
You know, what is the total, means, even though in the quarter it has done, what, 1,000 crores in revenue, if I'm not wrong, what is the kind of outlook you have for defense orders and, you know, and capital employed in that segment has always been an issue because the returns are not coming as expected. So can you give us an idea of what is the kind of order flow which you have?
Reframe your question. It's not the returns are not as expected.
It's slow, okay.
Yeah, it's little irritating. I call it a permanent startup. So we are well entrenched in defense. We are probably, we are the largest private sector defense player. So we have factories, I think we have 9 factories totally, the predominant ones being at Talegaon, at Coimbatore, and now this K9 Vajra factory and other smaller setups at many places, including Powai. Now, and including at Vadodara. The key point here is one of our investments is at Kattupalli shipyard, where we are okay. We are having a turnover of about 750, 800 crores. We have the OPVs, refits, interceptor boats, and such orders. But we need a big order. It's an investment being done, and therefore, unless you get a major order, turnover goes up, you earn some money, you can't pay back the interest. So to that extent, there's an issue there in shipbuilding. But the rest of the defense are going reasonably well. What we did in Hazira, the factory was a separate factory, including a test track for the K9 Vajra gun. It's a gun mounted on a armored tank, can fire about 45 to 50 kilometers within 5-meter radius. And it can shoot and scoot, move to another place. It's not a fixed gun, it moves on a tank. And therefore, it's a good product. We got selected against intense competition. That was the only product that got selected. And within a record time, 10 of those guns have been armored tanks, and armored tank-mounted gun has been supplied to the army, and we are well ahead of time in that process. We wanted to put it separately because it's a separate technology, both the hull and the turret, and it required special attention, so we put up a nice factory there and put it, and the Honorable Prime Minister was kind enough to come and inaugurate that factory along with our group chairman. Now, as we see defense, it takes time because any new order that we get has to be, regular orders we do get into a factory, but any new order that we get, it has to be prototyped, it has to be tested, there could be other competition, so we have to weigh against that, and we have to come number one, and then you bid, and finally you get it. So it's a time-consuming process because you look at India, it's got 4 or 5 different climates. It's the desert of Rajasthan, it's the coldness of the Kashmir, it is the wet conditions of the eastern part, and the plains of Punjab. And therefore, and we are not a rich country which can have 4 different types of a gun or a particular kind of defense product. So product normally has to go through all these 4 conditions because that's the resources we have. So it does take time. So having said that, the business has done reasonably well within its limitations. But it's a bet for the future. We continue to bet on it. There's no immediate major capital outlay plan because much of the facilities that we need are already available. And we'll continue to see how to utilize these facilities within the ambit of the requirement of the defense forces of the nation.
What's the total order inflow or order book for the defense?
About 5% of our total order book would be in defense. So.
Yeah. Done? Yes, ma'am.
You mentioned that there have been some orders coming in from the industrials, airports, and private sector. If you could just elaborate a little. You had mentioned in 2019 you were expecting the private capex to sort of come back.
I never elaborate on the clients or the kind of orders that we would get. The sectors is a big giveaway from my point of view, and you build on it now. Right, ladies and gentlemen, thank you very much. Appreciate your presence. Good luck.